Assalamualaikum and hi everyone. Welcome to another presentation, and in this presentation we're going to learn how to prepare a consolidated statement of profit or loss and other comprehensive income for a simple group structure that will involve a company called Balo and Tele. So let us look at the question first, and this is the question, and these are the two companies. Given below were the draft statement of profit or loss and statement of changes in equity for the year ended 31st of December 2020. So 31st of December 2020 will be our current financial year end. That will be our reporting date. So our reporting date that is for the current financial year end. You have the individual statement of profit or loss for Balu and for Tele as at 31st of December 2020. So when you prepare the consolidated statement of profit or loss and other comprehensive income, you are going to actually combine the revenue and expenses of the parent Balu here and the subsidiary Tele. And what would happen is that you are going to also exclude any intercompany transaction between group members. So the consolidated statement of profit or loss will only report the transaction between the groups and the external third parties. So it will not report transaction between group members or among group members, let's say between parent and subsidiaries or the subsidiaries with another subsidiaries. But in our case here is only one subsidiary. And therefore you are going to report only the transaction with the third party. So if there is any intercompany transaction or any transaction that involve things that do not relate to the external parties, that will have to be removed, including those transactions with the associate company. So you have here the revenue. So you have to look at the date of acquisition. So these are all the information that are familiar. You have the statement of changes in equity. So in this question, you're also going to prepare the consolidated statement of changes in equity. That would be our part or the second part of the answer, which is going to show the just the column of the retained profit and the column of the non-controlling interest. So these are the information that are being given. So these are information that is important here. 80% is the shares being acquired. So the holding hold 80%. And at the same time, if you see here, the subsidiary has 20% non-controlling interest in it. So then we have another one, the acquisition of the debenture of Tele. So the remaining debenture holder will hold 60% because the parent hold 40%. And if you also see here, the date of acquisition is on 1st of January 2019. This is the date of acquisition. And actually this is actually in the prior period. The reason is because the current year is 31st of December 20, and this is 1st of January 20, and this is 1st of January 19. So you acquire here, and this is the prior year, and this would be the current year. So the acquisition takes place in the current year, or is it in the prior year? So it is in the prior year. So that, if that is the case, these are the balances on the date of acquisition, which is on 1st of January 2019. You have the preference shares as well, but since there is no information about preference shares, you assume that this is belonging all to the non-controlling interest. So non-controlling interest will have 100% of the shareholding for the preference shares. None is belong to the parent, right? So all the preference dividend will belong to the non-controlling interest if there is any. Then you have the information on the date of acquisition for the fair value of the net asset, for the share capital, and for the retained profits. Those are some information on the fair value of the net asset, which is on the date of acquisition. So let's look at the first information here. You have the first information. This was an intercompany sale of asset, and this is intercompany sale of goods. So you are informed it was 250,000 per month, and that was since 1st of January So at a profit of 25% on cost. So this is actually a markup, right? And you are informed as of 31st of December, there was still a 6-month supply of these goods. So meaning that out of the 12-month goods that you supply each year, 6 months remain unsold in the books in the seller's inventory. So our case here is Tally is the seller. So this is again the so-called upstream sale. All right, so what you need to do is you need to find out what are the intercompany sales, the intercompany sales that were still unsold. So find out what are the unsold goods, which is the intercompany. Unsold goods here is 250,000, and you are informed 6 months were still unsold. So that is actually going to be 3,000. That was for the unsold good. However, for the intercompany sale or intercompany purchase, that would be 250 times 12. So this will give you 3 million, sorry. So this 3 million will need you to go and eliminate in the consolidated statement of profit or loss. But for this figure here, that would be 1.5 million. This 1.5 million, you need to find out what are the unrealized profit. So it would be unrealized profit would be 1.5 times 25 over 125, and therefore there is an unrealized profit of 300,000. So 300,000. So the unrealized profit also needs to be eliminated. Intercompany sale and purchase also needs to be eliminated. So you're going to do that in the consolidated statement of profit or loss. So you're going to go and remove it from the cost of sale for the intercompany purchase, and you're going to remove the sale from the turnover, right? So let's look at that. I've already prepared this template. So let's look at what we have here. So first, what you do is you are going to go and include the amount of the parent and the amount of the subsidiary, and now you are going to eliminate the intercompany sale. The reason the intercompany sale was being eliminated, as I mentioned, is to establish the correct group figures to be disclosed in the group accounts. And the second one, just now I have mentioned about the intercompany purchase. First, you add the cost of sales, and the intercompany purchase is adjusted in the cost of sales. So what you will do is this will be actually been debited to the cost of sales and credited to the inventories. So what happened is that the provision for unrealized profit that will arise out of the intercompany sales and intercompany purchase will also need to be adjusted. And when you do that, the unrealized profit that will have to be eliminated here, which is to add back to the cost of sale, would be for the 6-month period that was unsold. So multiplied by 250,000, which is the one per month. I was doing the working here, and multiply by the markup, and you will have 300,000. So the provision for unrealized profit, or in short it is called unrealized profits, of 300,000 will increase the cost of sales. And since the subsidiary is the seller here, so remember it was an upstream sale, the unrealized profit will also reduce later the non-controlling interest share of profits. So let's go to the second adjustment. Our second adjustment is on intercompany sale of machines. So look closely at the date of disposal. It was on 1st of September. This is in the current year. So it's important to identify when does the intercompany transaction took place. So here Tally, that is again the subsidiary. Same goes here, it was also the subsidiary. Sold a machine to Balu. So Balu is the parent, and Balu will be also the buyer. So Balo is the buyer and Tally is the seller. So what happened is a machine, which is a non-current depreciable asset, was sold at a profit of 500,000. So we have no information whatsoever on what was the carrying value, what was the selling price. There's no problem because you have the profit being given there, and you are also informed the remaining useful life of the machine was 5 years. So what you can do is you're going to take the profit and you're going to divide that with the remaining useful life of 5 years in order to arrive at the depreciation that have been over provided. But for the 500,000 that has been actually earned by Tally when it was selling the machine to Balo, that has to be adjusted by removing the profits that has been earlier realized. So that should be, you need to make provision for unrealized profit for that part. I'm referring to 500,000 divided by 5 years, and this one is related to depreciation adjustment, but this 500,000 is the one that we need to go and remove in terms of unrealized profit on sale of machine. So that was unrealized profit on sale of machine, and you are informed that the machine was still in the books of the buyer, which is Balo, at the end of the 31st of December on the reporting date. Even without the statement given there, you should also assume that machine still remains with the buyer. But here the information is very clear about the machine that was still remaining in the books of the buyer. So let's look at the effect. And normally the depreciation adjustment, it can be adjusted in the cost of sales for the case of excess depreciation, but here it is going to be adjusted in the admin expenses. So first what you do is you're going to add the admin expenses that you have, right? And you're going to adjust with the depreciation. So depreciation that has been overcharged was 100. So therefore your reported figure here is 2005, and the one here would be, as you can see, 41,500 for the turnover. The cost of sale was 20.7 million, and here the admin expenses was 2.5 million. And you can see in the question earlier, we just follow what we have in the question. So you can see here the first line item just now was revenue, cost of sale, admin expenses, and here you have the gain on sale of machine. Earlier on, you were informed in information number 3 that the gain on sale of machine was 500,000 that was included in the books in the record of Tally. So that was actually in the record of Tally here. So that this figure here is actually an intra-group transaction, and this must be removed. So when that happened, when you do the consolidation or the group accounts here, the gain on sale of machine must be now removed. You need to remove by taking 500, which is the one that was given in Tally's record, and you need to remove the intercompany unrealized profit on machine that was 500. So if, let's say, there are some other figures there, perhaps you have some excess here, so there will be some amount here, but here there is no amount, right? So therefore there is the gain on sale of machine is fully eliminated. Next one, we will be looking at the next information, which is, we have done number 2, we have done number 3. Now we look at number 4. Number 4 is about the dividend that was the income to the point of view of Balo, dividend income, but that has not been recorded. Bear in mind that dividend income from preference shares should not be taken credit by Balo. Dividend that has to be taken credit is the one coming from the ordinary dividend. So we are looking at the ordinary dividend. So you are informed that Balo has not recorded. So this is an intercompany transaction. Balo has not recorded. You need to record, but at the end of the day, you need to eliminate, since the dividend that was recorded or received from the subsidiary Tally is an intra-group transaction. So here it has not been recorded. since what you have is just the debenture interest income, which is also an investment income. So what we are going to do is in the consolidation, you will see that you will create one column, one row here. So I create dividend income right after the debenture interest income, dividend income, or this is investment income from dividend. And what you have received would be 480. And that 480, how do you arrive as that figure? That would be, this is some notes for you to take. Perhaps the parent will record the investment income, which is the dividend income, 800, sorry, it is actually 80% times 600. 600 here is the dividend by the subsidiary. So if you go to the dividend by the subsidiary in the statement of changes in equity, you have ordinary dividend of 600. And out of this 600, there are one that belong to the parent, and there are also things that belong to the NCI. So the one that belongs to the parent is 80%. The one that belongs to the NCI is 20%. So parent will have a share of 80%. So that will be first recorded. Yeah, here 480. How do you get 480? It would be, I can just put it here, 600 times 80%. That would be 480, but that must be fully eliminated since all 480 are intragroup dividends. So therefore, parent will record. However, as this is an intragroup transaction, this needs elimination in the group account. So this needs eliminating. Yeah, so it needs some kind of elimination in the group account. So we have to do that. And you are done with that. Next, we need to go and look at the debenture interest income that were in the question. So here you have, in this part, we are done here. This one is done. This one is done. This is done. So now we're looking at debenture interest expense and debenture interest income. Earlier on, you know that the debenture were acquired by the parent is 40%. So if that is the case, you can see here that debenture interest expense by tally was 2,000. So if parent acquire 40% of the debenture, parent will have recorded that 40% times 2,000, which is actually 800 in the individual statement of profit or loss. And that has been done by parent actually. Why? When you refer to the figure here, it was 800. So it is not just any debenture interest income that was recorded here, but it was debenture interest income, which is an intragroup transaction. If you have a figure more than 800, let's say 1,800, 800 is due from the subsidiary, but 1,000 may be the one from the external parties, the income from external parties. But here it is 100% from the subsidiary. So this needs elimination. And the figure here also needs to eliminate 800, which is the debenture interest payable to the parent company below. So therefore, in your workings or the adjustment section here, 2,000 is the debenture interest as per given in the statement of profit or loss of tally. And I'm removing the 800 portion which relates to debenture interest payable to the parent, which is 800. So therefore, what remains in the group point or in the group accounts would be the intercompany transaction that has been eliminated. So this is just the debenture interest expense to other debenture holder outside the company. So basically these are debenture interest expense that does not relate to the parent. That's the situation. And the subsidiary paid debenture interest of 2,000, and so the parent will have recorded the investment income in the form of debenture interest expense, and that amount is 800 as I mentioned. And As this is an intercompany transaction, this needs elimination again in the group account. So the rest of it for the taxation that you can see here, you just need to add up, nothing. You just need to add up the figures. So just add up the taxation figure. Right, and you will get the taxation to be 5246, and therefore your profit for the year, or the profit after tax, is 11854. If you look in the question, you would notice that in this question there are no transaction or no information related to other comprehensive income. Information number 4 is done. Information number 5 is just information on depreciation that we have earlier incorporated in number 3. Number 6 is just information telling that the profit and losses of the company were deemed to accrue evenly throughout the year. Information number 7 is just mentioning about how the measurement of non-controlling interest was done in this company, which is at the proportionate fair value of the assets of the subsidiary. So basically we are done with all what we are now going to have finished with our consolidated statement of profit or loss and other comprehensive income. And I'm going to show you how much of the profit for the year is attributable to the non-controlling interest, and how much is the one belonging to the equity holder of the parent. After that, we'll be doing the preparation of the consolidated statement of changes in equity using this information given here, using the information given in the statement of changes in equity. So these are all done. So let's do a calculation for the profit attributable to the non-controlling interest. So we're going to find out how much is attributable to the non-controlling interest. And the first to note is that this figure, profit for the year, 11854. I do not proceed with the other comprehensive income because there is no other comprehensive income. So we're going to find out how much belongs to the non-controlling interest, the share of profits of the non-controlling interest, and how much belongs to the equity holder of the parent or the parent company. So let's start with the profit for the year that is attributable to the non-controlling interest. What you need to do first is to take the profit that was in the question. So profit for the year of tally as per the question. So what you would see is that it is given here. Profit for the year was 4420. So you take 4420 there. Okay. Okay, fine. Then you need to do adjustment. So adjustment that you need to do here is adjustment to subsidiary profit in the current year. Let us look at the first adjustment. So we're now going to do the adjustment that relates to the non-controlling interest, which is the first one is on the unrealized profit for the inventory. Since the inventory, the seller is the subsidiary. So unrealized profit for in the sale of inventory, closing inventory, you can see it was earlier have been done 300,000. And the reason we do this is because the subsidiary sold the goods in the current year. Therefore, the provision for unrealized profit will also reduce the non-controlling interest share of profits. The second one is the unrealized profit coming from sale of machine. Remember, if you can recall again, the seller, they are both the subsidiary, right, for both the inventories and machine. So earlier on we have already calculated the over provision of depreciation, but this one is the machine, which is the unrealized profit on the sale of machine. So any remaining unrealized profit or loss arising on the transfer will be eliminated. How do we will remove it from the profit of the seller, and also we need to remove the excess depreciation as well, the excess or the over provided depreciation of machine that was already being calculated. That was 100, and that was here. We have done it here. this 100 that we earlier calculated. Next would be the preference shares. So here, if you can see, preference dividend were declared by the subsidiary and was paid in the year. So that preference dividend must be included, and what you should understand is that how much is the portion of that belongs to the non-controlling preference shareholder. So the non-controlling preference shareholder, we are trying to find what are the share of the non-controlling preference shareholder in the preference dividend. It was 100%, and therefore you have the 200,000, the non-controlling interest from the preference dividend, and the remaining here, which will be the total here. This is actually profit attributable to the ordinary shareholder, 3520, and the percentage is 20% since the parent hold a share of 80%, and therefore the non-controlling interest share of profit is 704, and that is 904. So this 904 will be included here, and the difference between 11,584 million and 904 will be shown as the one attributable to the parent. Right, you can just do the workings by taking 11,854 million minus 904,000. That will give you 10,950, and these are the percentage of the preference shares in the non-controlling interest, 100%. Next, we have to prepare the consolidated statement of changes in equity. So what you can do is to just put the profit for the year in the correct row, 10,950, and the share of the non-controlling interest in the non-controlling interest column. So what we're going to do now is to calculate the retained profit brought forward for the group as at 1st of January 2020, which is the one here. We start off by value, which is the parent. Check if there is any adjustment that need to be done by Balo. So if you can see here, this is Balo 5120. Let's be here. Then you have the go and check if there is any prior year adjustment. There were no prior year adjustment that need to be incorporated. Now we move on to tally. For tally, the first figure is the retained profit itself brought forward. Where do you take these two figures? You may wonder. This is from here. Okay, it was from there. And you include here. 5120, 1480. Pre-acquisition profit is the profit on the date of acquisition. So on the date of acquisition, the profit was 800. That was the pre-acquisition profit, 800. And you now have to incorporate the prior year adjustment. You should be doing also the same here in case you have. But there were none also here, none. So I just put nil there because none. Right, so that what you have is just the one of the retained profit brought forward. So here none. Right, you can just put 0 here if you want to. Next, the prior year adjustment. So we have no prior year adjustment. If you have any prior year adjustment in the 2019, for example, since the company was acquired 1st of January 2019, that has to be incorporated. If that affect the one of the subsidiary, it should be done here. The one effect of parent should be done here. Now you have the total. So your share of the post-acquisition profit brought forward. This is the post-acquisition profit brought forward. And the post-acquisition profit brought forward 680. Your share is 80%, and that gives 544, and that is your group retained profit brought forward. Your group retained profit brought forward would be the figure that you see there, that is 5664. Put it here, put it in the first row. Then we go on and find the non-controlling interest is similar. First is you need to go and find out what is the fair value of the net asset in tally when on the date 1st of January 2020, the one in tally. Right, so first you have to include the ordinary shares, assuming no changes to the ordinary shares balance. So the ordinary shares was 20 million, and that was here given in the question, 20 million. Then you need to include the one of the retained profit of the subsidiary, not the one on the date of acquisition, but the one on 1st of January 2020. It is here. Sorry about that. It is here 1480. So we take 1480 and we include here 1480. Then you need to go and look at if there is any prior year adjustment. In our case, nothing is done because no adjustment. Therefore, your post-acquisition profit brought forward to be shared by the subsidiary, non-controlling interest of the subsidiary from the fair value of an asset would be 4296 because the non-controlling interest is 20%. Don't forget about the preference shares. So remember earlier on you have the preference shares. Preference shares was having an amount of how much? You go and check the preference shares, 4,000. The 4,000 is here in this question, is here 4,000. So you take that figure, that is 100%. So 100% is the non-controlling interest in preference shares, and therefore you get 4,000. 4 million, sorry, 4 million. You look at the column here, it has the sign there, 48296. So this 8296 will be put here. And now you proceed with the dividend. Okay, for the retained profit column here, the dividend that you show here is the dividend that belongs to the parent only. So in our case, go and check the statement of financial statement of changes in equity. That was 2,000. Check if there is any additional dividends declared during the year. Additional dividend? No. So if there is none, that is the only thing that you include. And if you look at the preference dividend here, under the tallies column, 600 is the dividend. Earlier on, we have already taken into consideration and have eliminated the group dividend, which is the investment income from parent that relates to the subsidiary. That has been eliminated, but you will see that the remaining 20% will still be reported because this is the one related to the non-controlling interest. Same goes for the preference dividend. It will report all 100% here because all 100% is the non-controlling interest for the preference shares. So let's look at the consolidated statement of changes in equity here. So here this side, you have to report 120 because that is 600 times the NCI percentage in ordinary shares. And for the preference dividend, you will report all 100% and 200. And for this amount, there is no preference dividend declared by the parent. If there is any preference dividend declared by the parent, you need to include. So here is the balance carried forward at the end of the year for the group retained profit. This is the one that you will later transfer to the consolidated statement of financial position. This is the figure for the non-controlling interest relating to the share of profits, and this is 8880. And that's it. You are done with this question. This question is the final exam question, July 2021, where this acquisition is at the somewhere in the prior year. I thank you for watching. Try to get a good foundation of consolidation with this question. That I'll see you when I will see you, and assalamu alaikum. and have a nice day ahead.